Measuring the performance of key account management is uniquely difficult. You are evaluating a complex, ongoing relationship where the real forces determining success often happen beneath the surface, grinding against each other continuously. Because of this complexity, standard business scorecards break down when applied to key accounts. They are designed to measure simple, direct sales transactions, not the sustained management of a strategic partnership. This timeline shows a major structural tension. A supplier must hit immediate quarterly revenue targets, pulling left, while investing in long-term goals, pulling right. Another tension is tracking three distinct nodes: the supplier's internal performance, the customer's business outcomes, and their ongoing interaction. That third node, the interaction, is the exact point of failure for most measurement systems. Standard metrics easily track supplier revenue or customer spend, but they fail to capture the quality of the joint processes happening in the middle. Any valid key account management measurement system must balance these conflicting timelines across all three of those distinct entities simultaneously. To capture that level of complexity, we have to abandon the idea of using a single metric or even a single category of metrics to evaluate an account. A structural solution to this measurement problem was proposed by researcher Javier Marcos in 2018. The Marcos framework resolves this tension by splitting performance into two interdependent engines. The left side holds results-driven lagging indicators, the historical outcomes divided into financial and relational performance. The right side holds process-driven leading indicators, operational mechanisms divided into delivery, co-development, and customer experience. Organizing metrics into these specific categories provides a structure to track daily interactions alongside long-term results. Let's begin by isolating the first subcategory of the results side, financial performance. The foundational metric here is revenue growth. This is the basic rate of growth the supplier achieves in sales volume over a certain period. It is a mandatory baseline for any business evaluation. However, gross revenue must be heavily contrasted with profitability. Profitability is the actual level of profit or loss obtained from the key customer after all associated costs are tallied. In key account management, true profitability requires deducting a highly comprehensive list of expenses. You cannot stop at the basic cost of goods sold. This bar chart breaks down the necessary deductions. To find true profitability, you must subtract the costs of the supply chain and distribution, the expenses of all pre-sale activities, and the ongoing costs of post-sale support. Even after calculating that strict baseline, profitability only looks backward. To transcend historical data, suppliers rely on a forward-looking metric, customer lifetime value, or CLV. As this graph extends to the right, we see the mechanics of CLV. It is a quantitative estimation of the present value of the entire relationship. It takes all expected future revenues and expenses and applies a discount rate to convert that future projected money into a precise present-day value. While these financial metrics are strictly necessary, they ultimately only report the historical state of the balance sheet. They cannot tell you if the mutual interaction itself is actually healthy. That brings us to the second half of the results category, relational performance. The entry point here is customer satisfaction. This is an overall evaluation of all aspects of the working relationship, typically assessed through surveys administered by an objective third party. Satisfaction, however, is passive. A stronger metric is customer loyalty, which requires a much more demanding level of commitment from the account. Customer loyalty is divided into two parts. First is the attitudinal component. This measures the customer's active willingness to promote the supplier's brand and advocate for them over competing firms. This radar chart maps that attitudinal advocacy against the second component, behavioral loyalty. Behavioral loyalty is the physical act of purchasing a greater amount and a wider variety of the supplier's products over time. The final relational metric ties these elements together, relationship quality. Relationship quality assesses the underlying structural state of the partnership. It specifically measures the current level of conflict, the depth of mutual trust, and the degree of commitment both parties have to an ongoing future. By tracking satisfaction, loyalty, and quality, suppliers gain the necessary context to explain exactly why their financial metrics are trending up or down. We can now shift our focus from the lagging outcome metrics to the operational inputs that actually generate them. These are the process-driven metrics, acting as the gears that drive the entire relationship. The first category within this operational engine is delivery to the customer. Here, we measure the product and service mix. This acts as an indicator of sales quality by tracking the breadth of the portfolio currently being sold to the customer. Next is solution development. This moves beyond simply selling a wide mix of existing products and measures how effectively the supplier creates tailor-made solutions to solve the customer's specific problems. Finally, delivery includes the cost to serve. This is a strict metric of efficiency. As the two companies learn to work together, their operational efficiency increases, heavily reducing the need for expensive, redundant controlling mechanisms. Delivery metrics are standard, but key account management requires moving to a more advanced operational tier: co-development with the customer. When both buyer and supplier face challenges differentiating themselves in the market, they jointly develop new solutions, innovative new services, or supply chain processes. This requires information sharing, measured by the strategic exchange of unique market knowledge between the two companies. In this diagram, we see the ultimate test of co-development: shared investment. This metric tracks the customer's reciprocity and their tangible willingness to jointly commit resources and capital into a shared objective. Delivery and co-development form the literal, day-to-day mechanics of the interaction. They serve as the mechanical engine that physically produces the relational and financial outcomes we looked at earlier. The third and final process category is customer experience. This metric evaluates the customer's cognitive and affective assessment across all direct and indirect encounters they have with the firm. This journey map traces the timeline of those encounters. The experience metric tracks sentiment continuously across the pre-purchase exploration, the purchase itself, and the long-term post-purchase relationship. This metric recognizes that the B2B customer is an individual with specific cognitive and emotional aspirations rather than a purely rational purchasing agent. A supplier must move beyond basic competence to deliver engaging, compelling encounters that fulfill the customer's hedonic, emotional, and sensory aspirations. Mastering the customer experience process ensures the long-term emotional stickiness required to hold a key account together, even when they inevitably face difficult financial quarters. The dashboard functions through a causal flow. Process metrics on the right act as inputs for results metrics on the left. Efficient cost to serve increases profitability. Solution development and customer experience extend lifetime value. Strong results then justify shared investment, creating a self-sustaining loop. High-level financial metrics, like revenue growth spikes, are entirely unsustainable without the continuous operational engine of the process metrics running smoothly in the background. Key account management performance consists of continuous, ongoing development, rather than a single static snapshot of a ledger. Effective performance measurement centers on the ongoing continuity of the relationship. Tracking delivery, co-development, and experience allows suppliers to identify the specific operational drivers of financial results. To accurately evaluate an account, organizations must abandon isolated scorecards for a balanced framework measuring the supplier, the customer, and the interaction between them. A successful key account management program requires a system that values the shared long-term interaction precisely as highly as the short-term profit.